Buffett does not view the stock market as a casino. He views it as a grocery store for businesses. If he walks into the store and sees that the price of hamburger meat has jumped from $5 a pound to $50 a pound, he does not buy it just because everyone else is buying it. He does not care if the butcher says hamburger meat will go to $100. He looks at the price, he looks at the value, and he walks out of the store. Right now, the entire United States stock market is priced at $50 a pound. The metric Buffett uses to measure this is simple, elegant, and historically undefeated. It is known as the Buffett indicator. Mathematically, it is the total market capitalization of all United States stocks divided by the gross domestic product of the United States. Think of this as a price-to-sales ratio for the entire country. The gross domestic product represents the sales, the actual economic output, the goods and services produced by every worker and machine in America. The market cap represents the price, what investors are willing to pay to own a piece of that output. For most of the 20th century, this ratio fluctuated between 50% and 100%. When it was at 50%, stocks were cheap. When it was at 100%, stocks were fairly valued. Where are we today? As we head into 2025, the Buffett indicator is hovering near 200%. Let that sink in. 200%. This means the stock market is valued at double the size of the actual economy it represents. This is not just expensive, this is a statistical anomaly. This is 2 standard deviations above the historical trend line. To put this in context, let's look at history. Before the dot-com bubble burst in the year 2000, a crash that wiped out 80% of the Nasdaq, the Buffett indicator peaked at roughly 159%. Before the great financial crisis of 2008, it was around 110%. We are currently far higher than both of those peaks. We are standing on a ledge that has never existed before. Buffett knows that corporate profits cannot outgrow the economy forever. It is mathematically impossible. Eventually, profits must revert to the mean. Eventually, valuation must reconnect with reality. When the Buffett indicator is this high, the expected annualized return for the S&P 500 over the next 10 years is not 10%.